Okay, g'day, Rudy here. This video is all about looking at the top holdings of Australian Super and Australian Retirement Trust and seeing how you could have quite easily beaten them with doing it yourself with one of those little member direct options. But first of all, because you probably never looked at what they actually are holding. So both of them, so if we look at Australian Super, they allow you to download their actual shareholding. So this is what the fund in your high growth option owns. So 3% of it is sitting in Commonwealth Bank and 2% BHP, Microsoft, National Bank, Nvidia, Westpac, CSL. So this is in order of weighting: Amazon, Rio, Macquarie, Wesfarmers, so all the usual names. And then we've got Woodside down here at 1%, and QBE, Meta, Computershare, then we've got a gold miner there, Gold Copper, Evolution. So that's Australian Super. Now the same thing for Australian Retirement Trust. You can go in high growth pool, you can go and download their holdings, and this is what they've got. So their top holding is actually an unlisted equity externally managed. So they've given some money off to another fund manager to invest in shares, which is fine. That's no problems. So their top holding direct shares is Commonwealth Bank. Then they've got some unlisted infrastructure, so probably some windmills, solar panels. God knows how they value them, but that's another video topic. Okay, so the next direct shareholding is BHP. Then they've got some fixed income externally managed. Okay, so now we get back to direct shareholdings: NAB, Westpac, CSL. So similar names to, they all basically hold the same thing. They just got different pet projects, different windmills that they buy. Wesfarmers, ANZ, Nvidia, Macquarie, Microsoft, Goodman, Apple, QIC, Telstra, Amazon. Okay, and then we come down here to Woodside, 0.55. Okay, so they all start off with, they all basically look the same, and that's why they all get, over 5 years, 8%, 9%, 10%, whatever it is. Okay, so this is what, so I've got a channel, a YouTube channel. Obviously, you're watching it, and part of what we do here is help people build their own share portfolio within those member direct. A lot of super funds do it. So we had a model portfolio. Basically, there's absolutely no banks in there. We've got a heavy weighting towards Woodside. It was last calendar year up 45%, and we're up 15% this financial year. But that's so I'll do the plug. $10 a month. We do ASX and US shares and ETFs. There's even places like Stake Super where you can buy US shares and ETFs, which we do. But the point was, so they were overweight Commonwealth Bank, and from the Roosters' point of view, they were a sell back here, and they're recently become a sell again. Whereas Woodside has been buying the heck out of it. So you could have been buying these in your member direct super fund, and it's like a rocket ship for a blue chip. And if we why did we do that? So what we do is we use these ratio charts. So if we take Woodside and divide it by C, so this is CBA outperforming Woodside as you come down, and then back here in July it was the first signal that Woodside, this is their growth, was going to start outperforming Commonwealth Bank. And so you can see here it's so outperformed capital growth wise by 37%. And then just to rub it in, Woodside's dividends 7% and Commonwealth Bank's 2.6. So Australian Super, they've dudded you by not, with income and growth, by not being overweight Woodside. And just on this super fund thing, they basically, like as you just saw then, the names are all sort of the same, and they all basically invest in something like this VDHG. Yes, they'll go and buy their own things or whatever, but just to show, because everyone, you know, they'll say who was the best super fund last year? You know, someone got 10, someone got 12%. So if we just look at this VDHG, so for last calendar year, from there to there, so 13%. So I think Host Plus or someone got 12%, or anyway, that's because this VDHG is basically a high growth option. And saying if you do it over 5 years, so if you go from here to there, so that's 5 years, 77%. What do most super funds say? Oh, we'll get you 10%. You know, you look at the average returns, 10% over 5 years. Well, if you compounded that, you'd get 61%. So this thing actually, just by investing in this, you would have outperformed your super fund. And this actually is an ETF that you can buy in your member direct. So you could have outperformed your option just by picking this. And so the same issue goes. So if we talk, not that you can buy all of Woodside in your super fund, but if we divide it by, you know, your growth fund option, you can see there that's a nice 32% just in the last month or so you could have made in your super fund over your high growth option, because you can see basically for the since October last year, your super fund's growth super option's gone nowhere. So if you've got if your super fund, if you can find out and you reckon they've made more than zero in the last 3 months, let us know. But they don't tell you. They just tell, because those unlisted equity things is how they basically smooth the returns. They just, oh yeah, I reckon that solar farm's worth this. This data center's worth this. Anyway, so the point of the video was just to let you know they all sort of invest the same, and you can do a lot better by just doing it yourself. And that's what we do here on the channel. We help provide guidance. We had a recent comment here from someone who just joined. Thanks heaps, Rudy. 2 weeks in the rooster school now, and yesterday I cleared my last year return with AMP 8%. Unbelievable. I was also wondering what you think of Venom. It's an oil and gas play. So it can be done. That's on not making it up. And subscribers will send a message if I'm talking shit. Yeah, all right, have a good one. See ya.